Hello everyone, welcome back to the channel, it's your host. Today we're going to dive deep into something that's causing waves across the world economy. It's about none other than the looming tariffs promised by US President-elect Donald Trump. The fallout doesn't stop at Washington's borders, it's creating ripple effects across the entire global financial system. Tariffs, trade, disruption, uncertainty, sounds like fun, right? Well, buckle up, because this roller coaster of economic confusion and mismanagement is hitting every country, every market, and, quite frankly, every one of our wallets. Now, what do we have here? IMF Managing Director Kristalina Georgieva mentioned something very interesting recently. She highlighted that Trump's trade policies are pushing up borrowing costs globally. Yes, that's right, globally. Especially the longer-term interest rates are climbing while shorter-term rates are actually falling. Weird, isn't it? Imagine going into a store where ice cream prices keep going up, but the toppings are getting cheaper, totally unexpected and illogical for traditional economic theories. So, what's really going on? Well, we're seeing a cocktail of uncertainty, inconsistent policies, and outright economic protectionism. What does that mean for you? Higher interest on mortgages, more expensive loans for businesses, and a slow but steady crush of economic activity. And trust me, we're just getting started. To provide some context, Trump has promised to hit imports with tariffs left, right, and center, from adversaries like China, to even allies like Canada and Mexico. This trade war rhetoric isn't some domestic game played inside US borders. The entire world is watching, especially because the US economy is intertwined with global supply chains. Tariffs on imports don't just mean higher prices for imported goods in American stores, it means manufacturers across Europe, Asia, and beyond are going to feel the burn too. Let's not forget how inflation fits into this. Higher tariffs are often translated into higher prices for consumers, both in the US and abroad. In terms of numbers, the potential global output could shrink by around 0.5% according to the IMF's chief economist Pierre-Olivier Gourinchas. Yeah, that little tariff here and a little trade spat there can slow down global economic growth, by quite a bit actually. The US may seem massive, but when it sneezes, the world catches a cold. Georgieva hit the nail on the head. Countries integrated into global supply chains, particularly economies in Asia and other middle-sized economies heavily reliant on trade with the US, have no choice but to brace themselves for shocks. Let's talk specifics. Mexico and Canada have a lot to lose because both countries serve as hubs in intricate supply chains that connect manufacturers across North America. Just look at the auto industry, a car might cross the US-Mexican border several times during production. Now add on tariffs each time, costs pile up. For Chinese manufacturing, it's even more complex. Key components, raw materials, and finished goods all depend on seamless trade flows. If tariffs disrupt this system, global inflation pressures will skyrocket, which, surprise, means further headaches for central banks around the world who are already struggling with post-COVID economic stagnation. Something's fishy with interest rates too, and no, I'm not talking about your typical rate cut or hike dilemma. Here's the crazy part, short-term interest rates are falling, and longer-term rates are accelerating upwards. This is a peculiar divergence that has everyone, from Wall Street to Brussels, scratching their heads. Why does this matter? Because Trump's policies are sowing an exceptional level of uncertainty in global markets. Investors are freaked out. Longer-term borrowing costs are rising because uncertainty around trade, global supply chains, and potential recession risks are causing investors to demand higher risk premiums. Whereas shorter-term markets still see a slower recovery with central banks remaining cautious. Let's break this down in simpler terms. If you're a business looking to expand with a loan, be ready to pay a lot more than you did before. Higher long-term rates mean that financing new projects becomes costlier, stifling investment and productivity growth. This then leads to a vicious cycle of lower production, fewer jobs, and even greater economic malaise. Sound dramatic? It isn't. Because this is what happens when markets lose faith in future outcomes. The fact that these interest rates are going haywire is basically the economy waving a giant red flag. The US Federal Reserve may keep its short-term rates manageable, but higher uncertainty about future economic conditions is pushing up long-term borrowing costs. Look around, developing economies, especially in regions like Latin America, Asia, and Africa, don't have the luxury of brushing this off. Meanwhile, what happens when investors around the world start panicking in the face of Trump's uncertainty? They rush towards the so-called safe havens, and guess what, the US dollar fits that bill perfectly. Over the last few weeks, we've seen a significant dollar surge, extending through the closing weeks of 2024 and into 2025. Now, on the surface, this sounds like a good thing for the US, right? A stronger dollar means you can buy more stuff overseas for less money. Well, not so fast. The spillover effects for other countries are downright alarming. For emerging markets and low-income countries, it's like watching a slow car crash. A stronger US dollar makes things really difficult for these economies. Why? Because a lot of global debt is denominated in US dollars. Countries like Argentina, Brazil, Turkey, and other emerging markets that rely on foreign loans or investments suddenly find their debt burdens inflated. Essentially, their local currencies weaken relative to the dollar, meaning they've got to fork out more to service debts, which drains resources from critical sectors like infrastructure, healthcare, and education. Let's not forget about inflation in these countries. A rising dollar contributes to rising import costs, and many of these nations depend on imports for critical commodities. That's a 1-2 punch leading to inflation and slowed growth, something the IMF has been warning about for years. Higher inflation burdens consumers in these emerging economies, effectively reducing living standards, another deep, tangible consequence of these seemingly distant trade wars. IMF Managing Director Kristalina Georgieva isn't painting a rosy picture either. The global economy is essentially treading water, mediocre growth, diverging regional performances, and stubbornly high inflation. In October 2024, the IMF forecasted global growth at 3.2% for the year, but this number is looking weaker and more fragile as 2025 sets in. The big question is, what happens next? Let's look at regions in more detail. Georgieva noted that the US is performing better than expected, well, thanks to that dollar surge we just talked about, but the European Union is stalling. Europe's energy crisis, thanks to Russia's geopolitical maneuvers during 2024, is partly to blame. Then there's China, a juggernaut in economic growth for decades. Now, they're grappling with deflationary pressures and low domestic demand. This is highly concerning because China's factory floors play a massive role in global supply chains. When demand drops within China, global exporters don't get their orders fulfilled, leading to ripples throughout the economies of almost every continent. Meanwhile, India, which has been another engine of global growth attempting to match China's trajectory, is facing weaker than expected performance. The country is dealing with low confidence from investors, and rising interest rates are dampening domestic investment potential. These divergences are happening while businesses, workers, and consumers in each of these regions are feeling the pinch, so we're not looking at a promising start to 2025. Looking into the data, we're seeing a mixed picture. For example, the US as of December 2024 saw GDP growth of 2.7%, marking it stronger than expected, but not at the same levels as pre-pandemic recovery rates. The Eurozone, plagued by inflation and an energy crisis, posted GDP growth of just 0.3% in the fourth quarter of 2024, a dismal result for a large trading bloc. China, staggering under its credit burdens and deflated property market, recorded 0.2% quarter-on-quarter growth at the end of 2024, official stats that are likely buoyed by suspect economic manipulation. Despite their rapid investments in technological sectors, China's core sectors like manufacturing, real estate, and retail are considerably depressed. And India? 1.5% GDP growth quarter-over-quarter sounds decent, but it's lower than expectations, meaning the South Asian giant still has more room to improve, not least for a country priding itself on being a tech and pharma power in the making. So, where do we go from here? Well, to be clear, the global economy doesn't have an easy way out of this mess. The IMF regularly mentions lackluster growth potential, but now it's forecasting potentially hundreds of billions of dollars in productivity losses if protectionist policies and trade uncertainty persist. Emerging market economies will need aid, adjustments, and access to financing. They'll need to brace themselves for cutbacks, restructuring, and possibly IMF intervention. The big global players, whether it's the US, EU, or China, are flipping markets upside down with unpredictable policies. Trade protectionism, self-serving political agendas, and short-sighted fiscal strategies will inevitably drag economic growth down while inflation levels jump. Welcome, folks, to the new normal, an era where economic complexity dances hand-in-hand with political nonsense. Trump's tariffs are the sharpest undercut of globalization we've seen in recent history. As the world reacts to rising interest rates, a stronger dollar, and ever-tightening credit markets, make no mistake, 2025 is going to be a bumpy ride. Ordinary citizens around the world will feel the brunt. Whether you're a consumer who notices prices subtly creeping up at the grocery store, or a business owner wondering why you can't qualify for loans as easily anymore, this is the economic reality shaped by protectionist mindsets and global mismanagement. For now, keep your eyes glued to those global headlines, and more importantly, keep your wallets close. Because 2025 is shaping up to be a year where the unforeseen becomes the everyday, and where everyone, from Wall Street bankers to blue-collar workers, will be singing the same song, uncertainty. That's it for today's deep dive. Don't forget to like, subscribe, and hit the notification bell for more no-nonsense analysis on global financial trends. Stay sharp, stay informed, and remember folks, we're just getting started.